traders at Access Bank say that they expect to see improved offers for federal government bonds today. They also expect a bearish market due to funding activities expected today. Akpevwe Oputu, a fixed income dealer at Access Bank, joins us now to give us some perspective on how the markets are trading right now. Thank you so much for your time. Akpevwe, let us get your thoughts, first of all, on the trends that we're seeing in terms of liquidity ahead. It's pretty tight right now. Do you get the sense that it's going to loosen up next week? And if so, where are we expecting the supplies from?
Okay, good afternoon. Thank you for having me on the show. So right now, we've seen a bit of liquidity squeeze in the market. There's actually a retail SMIs auction happening today, so we expect a debit to impact the system and the liquidity cleans out for that. And these are actually spot rates up in the money market space. So we see OBB and overnight rates trading around 17 and 18% levels. Also, earlier this week there was an auction, PMA auction this week, and they had a sale of over 88 billion more than what was on offer. So that actually took out some liquidity from the system yesterday. There was also an OMO auction that was conducted in the market yesterday. So 30 billion was also mopped out from the system. So this actually affected the liquidity that we see in the market. For the bond space, we expect that the market should be bearish. We expect to see people come into the market to sell some of their bond holding, given that there's a bit of liquidity squeeze right now, and the forthcoming auction on the 23rd. So we'll see market players try to sell off at the yields currently trading at now, so they can be better positioned for the expected bond auction coming up.
Right. If you can speak briefly about the foreign exchange markets, because we see in the papers many banks advertising and calling for their customers to take advantage of the opportunities to get foreign exchange for a variety of items. But we continue to hear of a paucity of funds in the I&E window. Can you just explain why we're seeing that if the central bank is making those funds available, especially for retail investors or retail customers?
Okay, the central bank is actually doing a lot to see that they pump in FX into the market. They've actually come into the system on Mondays and Wednesdays to see that they make funds available to the foreign direct investors. I think they do about $40 million weekly for that, at about 410 naira to the dollar. But the demand in the market still outweighs the supply that we see. We don't have enough funds coming in through the I&E window. So we continue to see this paucity of funds, even though the CBN has tried so much to see that they provide for the SME and invisible weekly allocations. They've actually even contacted banks to see what the outstanding demand is in the market, to see if they can increase the volume for this. So I'm sure they're doing a lot to see that this demand is met in the market. We've actually seen stability in the parallel market rates because the CBN is doing a lot to see that they intervene for the FDIs, and they're actually even looking at intervening for the local corporates as well. So as much as possible, they're trying to stabilize the currency. So banks are urging customers to take advantage of this CBN intervention so they can meet the immediate demands in the market.
All right, coming back to the fixed income and money markets, what's the outlook for rates moving into next week, starting with the T-bill market and then moving on to the bonds?
Okay, for the Treasury bill space, there's actually an NTB auction that is expected to hold next week. About 14 billion is on offer across the 3 standard tenors. We saw there were a lot of demand at this auction that was conducted, and not all the subscription was met. So we expect that to filter into the next auction scheduled to hold on Wednesday. So we'll see a bit of demand in that space. We expect the rates to remain stable as they've done over the past. We saw the 90 days trading around 2%, the 182 days at 3.5, and the 1 year coming down by 1 basis point to close at 9.64%. So we expect that the 1 year will continue to trade around those 9.6, 9.64 levels. So there's a bit of demand on that space. For the bond market, we still continue to see a bearish trend coming into the new week. As I said earlier, so banks are going to try to sell off on their positions to take advantage of the auction that is expected to hold on the 23rd of June, where rates are expected to trade much higher than what we are currently seeing on the secondary market, where bids are around and offers are around 13.7 to 13.9% on the 2050s, the 2049 bonds now.